Hi everyone. Welcome to Level Up channel. For those of you who watch my videos for some time now, know I love investing in dividend stocks. So far, I've been talking about regular companies, most of which listed in the S&P 500. These companies pay taxes on their earnings before sharing their wealth with shareholders as dividends. Shareholders then pay taxes on the dividends they receive, creating a double taxation. A master limited structure allows profits and taxes to be distributed directly to limited partners. In this case, taxes are paid only once. Additionally, investments in real estate or natural resources, where income is produced and certain tax benefits, such depletion and depreciation, can be leveraged to minimize the taxes on that income for investors, work particularly well for the limited partnership form. This is how a lot of energy-related partnerships are set up so that the limited partners can receive income that is tax-favored. Similar to traditional partnerships, MLPs have a general partner who oversees the business or operation and limited partners who act as investors. When we speak about partners, we distinguish general partners and limited partners. The partnership's management, including sending payments and messages to the limited partners, is handled by the general partner. Additionally, general partners take on the entire venture's liabilities, shielding the limited partners. GPs can be one person, but they are most often companies or LLCs. Typically, firms connected to major multinational corporations run the majority of MLPs. The investors are the limited partners. They invest the money to start the business, and in return they could receive income as well as possible appreciation that might also be tax-favored. Limited partners are exempt from any venture liabilities. If you made it so far, you know that MLPs have a special taxation advantage. Hear how it works. MLPs are not taxed as separate entities as long as they adhere to the IRS rules. The mandate that real estate or the production, processing, exploration, or transportation of natural resources account for 90% of an MLP's income essentially restricts the use of MLPs to specific industry areas. If an MLP satisfies the conditions, it may port through its earnings to the general and limited partners. In most MLPs, the income that is passed through to the partners might benefit from write-offs for depreciation or depletion, giving the partners the possibility of at least some tax-free income. Additionally, MLPs have the ability to distribute income that is virtually a return of capital and is not taxable at all. The recapture of gains would then be subject to long-term capital gain rates when the MLP eventually liquidates its assets. Now let's see some examples of MLPs. Number 1, Enterprise Product Partners. Dividend yield, 7.6%. Dividend safety, 65. Dividend growth, 2% per year in the last 5 years. Payout ratio, 57%. Number 2, Energy Transfer. Dividend yield, 8.02%. Dividend safety, 50. Dividend growth, minus 11% per year in the last 5 years. Payout ratio, 33%. Number 3, MPLX. Dividend yield, 9%. Dividend safety, 41. Dividend growth, 6% per year in the last 5 years. Payout ratio, 61%. Number 4, Icon Enterprises. Dividend yield, 15.21%. Dividend safety, 35. Dividend growth, 6% per year in the last 5 years. Payout ratio, 100%. Number 5, Magellan Midstream Partners. Dividend yield, 8.39%. Dividend safety, 61. Dividend growth, 4% per year in the last 5 years. Payout ratio, 83%. Number 6, Brookfield Renewable Partners. Dividend yield, 4.59%. Dividend safety, 60. Dividend growth, 0% per year in the last 5 years. Payout ratio, 45%. Number 7, Western Midstream Partners. Dividend yield, 7.67%. Dividend safety, 50. Dividend growth, minus 6% per year in the last 5 years. Payout ratio, 40%. Number 8, Cheniere Energy Partners. Dividend yield, 5.68%. Dividend safety, 43. Dividend growth, 10% per year in the last 5 years. Payout ratio, 60%. As you may notice, MLPs offer very interesting dividend yields, mostly over 7%, which could entice many investors to put money in. However, notice that the dividend scores are borderline. In addition, these companies tend to reduce their payments year in and year out. For those who follow me for some time, No, I don't like to invest in companies that don't grow their dividends, even if, for the case of MLPs, these companies' income is usually tax advantaged or entirely tax free. Most MLPs are found in the energy industry. There aren't many other MLP options for investors who don't feel comfortable buying oil and gas related equities. Before getting on, please push the like button to help grow the channel and spread the video among other fellow investors. Don't forget to subscribe to the channel for similar content. You are welcome if you have any suggestions or ideas you would like me to highlight in a video. I would be pleased to. Thanks everyone. Another type of companies that aren't very spread among the general public is BDCs. BDCs frequently offer dividend yields of 5% to 14% or higher, which may be excessive. Particularly in the current low interest climate, certain outperforming BDCs may also occasionally offer dividend hikes, making them desirable investments for income seekers and retirees. However, greater returns also come with higher risks, so before including BDCs in your portfolio, do some research. A business development firm makes investments in small and medium-sized, privately held businesses. Typically, the companies require funding to grow or get back on track since they are having difficulties and may not be able to do it through conventional channels like bank loans or bond issuance. Similar to venture capital or private equity funds, BDCs seek to make money when the businesses they participate in are sold. Due to the fact that virtually everyone can invest in them, business development organizations make appealing alternatives. They are public corporations that trade on significant stock markets, which explains this. Accredited investors with high net worths are the only ones who can access venture capital and private equity. I'll give now some examples of BDCs. Let's get into the list. Number 1, Rand Capital Corporation. Dividend yield, 4.29%. Dividend safety, unrated dividend growth, minus 20% per year in the last 5 years. Payout ratio, 99%. Number 2, Great Elm Capital Corporation. Dividend yield, 18.9%. Dividend safety, unrated. Dividend growth, 5% per year in the last 5 years. Payout ratio, 99%. Number 3, Portman Ridge. Dividend yield, 12.59%. Dividend safety, 40. Dividend growth, minus 16% per year in the last 5 years. Payout ratio, 68%. Number 4, Investcorp Credit Management. Dividend yield, 15.87%. Dividend safety, unrated dividend growth, minus 13% per year in the last 5 years. Payout ratio, 96%. Number 5, Herucles Capital. Dividend yield, 11.11%. Dividend safety, 45. Dividend growth, 1% per year in the last 5 years. Payout ratio, 104%. Number 6, Goldman Sachs BDC. Dividend yield, 12.23%. Dividend safety, 26. Dividend growth, 0% per year in the last 5 years. Payout ratio, 83%. Number 7, Golub Capital BDC. Dividend yield, 9.28%. Dividend safety, 25. Dividend growth, minus 2% per year in the last 5 years. Payout ratio, 106%. Number 8, Owl Rock Capital. Dividend yield, 11.51%. Dividend safety, 50. Dividend growth, 77% per year in the last 5 years. Payout ratio, 95%. Number 9, Ares Capital. Dividend yield, 9.72%. Dividend safety, 59. Dividend growth, 1% per year in the last 5 years. Payout ratio, 86%. Number 10, Gladstone Investment Corporation. Dividend yield, 7.85%. Dividend safety, 41. Dividend growth, 3% per year in the last 5 years. Payout ratio, 120%. Number 11, Oxford Square Capital. Dividend yield, 14.29%. Dividend safety, 8. Dividend growth, minus 18% per year in the last 5 years. Payout ratio, 120%. Number 12, Pennant Park. Dividend yield, 10.66%. Dividend safety, 19. Dividend growth, minus 16% per year in the last 5 years. Payout ratio, 75%. I always remind the viewers in every video to make research before investing in any stock. I must make a special emphasis on the BDCs. Even if the dividend yield is very alluring, it is most of the time very unsafe. The figures are as plain as day. Moreover, the BDC format was invented in the 1980s, although it has only been widely used since the early 2000s. As a result of their recent history, prospective investors have little data to use while evaluating their possibilities. You should also pay attention to taxes when you buy share in a BDC. BDCs themselves are exempt from paying taxes, but you are not. In fact, because BDC dividends are taxed at ordinary income rates, or the standard rate you pay on income like your paycheck, you'll likely wind up paying more on your BDC dividends than other dividends in your portfolio. For instance, the tax rate on any BDC dividends received in 2021 for a single person with an annual income of $50,000 would be 22%. What about closed-end funds? A closed-end fund launches an IPO, and the money raised is used by portfolio managers to purchase assets. Closed-end funds, KEFs, despite being traded in the US for more than a century, are little understood. A KEF is not an exchange-traded fund or a regular mutual fund, as is frequently believed, ETF. Unusual mutual funds that are closed to new investors are not closed-end funds. A KEF is, at its most basic level, an investment vehicle, not an asset class, that is governed by the Investment Company Act of 1940. Similar to a stock or an ETF, a KEF is a type of investment business whose shares are traded on the open market. A KEF invests in a portfolio of securities, just like a standard mutual fund, and is often run by an investment management company. KEFs are closed, in contrast to mutual funds, in that money does not typically flow into them when investors buy shares or out when investors sell them. As opposed to open-end mutual funds, shares are not immediately traded with the sponsoring fund family after the initial public offering, IPO. As an alternative, shares are often traded on an exchange, with other market players serving as the matching buyers or sellers. Daily share issuance or redemption is not done by the fund itself. I really hope you find the video very informative. It took me hours of research to make it. Remember, I am not a financial advisor. Make sure you make your own due diligence before investing. Please push the like button to help spread the video among fellow investors. Don't forget to subscribe to the channel for similar content. Thanks everyone. I'll see you next time.